I've been trading for around 14 years and I've learned that you should only trade with the trend. But why is it actually so important that we trade into the trend direction? And there are three main reasons. First, your trades will work much faster. Second, it's going to be much easier on your emotions and for your trading psychology. And third, you're going to realize much bigger winning trades. And that's why in this video I've compiled 10 strategies, 10 approaches, 10 tips on how you find the trend direction and how you can trade into the trend direction for much better trading results. So let's get into the video. And I've divided this video into two parts. In the first part, we're going to take a look at the 10 trend trading strategies. So I'm going to explain a few multi-time frame approaches, how you can actually understand the trend direction and then find trades and enter trades into the trend direction. And in the second part, I have compiled 6 price action tips that will help you improve your chart reading, your technical skills, and just provide you a much deeper understanding of your price action charts. So let's start with something basic, and I will show you a better way on how to trade and use channels in your trading. So very often we will be able to define trending markets within channels. A channel consists of 2 trend lines, one on the lower side and one on the upper side. And in this example, you can see that we are able to put the trend into an upward sloping channel. And this obviously describes then a bullish trend. The market is moving higher. But how do we use that to find trading opportunities? First of all, it's very important that if you are looking at an upwards sloping channel and you're looking at a bullish market, you're only allowed to find long entries, only buying opportunities. If you find yourself in a bullish trending environment, you are not going to go short. A big mistake that many traders make is that if you see that there's a channel, the channel is going higher, then they will go short on the touch point of the upper resistance area. But this is wrong. A channel in an upwards sloping market should only be traded at the lower end. You only want to go with the trend, obviously. And with the trend, opportunities are found on the lower side. And this is how it looks. So we can use other tools on top of our channel, inner trend lines, inner support and resistance levels to time our trades. So here we have a few options. So within the long-term upwards channel, we are able to find other trend lines. So for example, here we are able to connect 1, 2, 3 lows. And then you can see the market reaches this long-term channel here. And also it bounces off of this inner trend line. And then it moves higher quite quickly. I will show you later why it's so important. And I've prepared a few examples and tips why it's so important that we trade into the trend direction. Here we have another example. We're able to put in a trend line here at the resistance level. It becomes support on the breakout. So you can see resistance turns into support. And then you're able to find moves higher. Here, then we have another inner trend line, and we can use it after the move into the outer channel area. It finds support here at this inner trend line, breaks above it, and moves higher. Here we have another example. The market is in an upwards move, puts in a consolidation, gives us this nice resistance level, breaks out, and continues higher. So there are a few options that we can use such a channel to time with the trend entries within the channel. And again, if you find that there is an upward sloping channel, only look for buying opportunities. Sometimes, obviously, a channel will end, and if you see that the market is from this upward sloping channel breaking out, so it's actually breaking out below the lows, then very often you will be able to find trading opportunities into the new trend direction. So when a uptrend goes over into a downtrend, those can be quite profitable trading opportunities. So you can see here the market is first breaking out of the channel, then it's making higher equal lows here. This high is being retested. At this point now we are able to define this downward move with a new trend line. So now that the market is going from upwards to downwards, we are looking for a trend line and a channel at the upper area of the price action, because obviously now we want to go short, and we can only go short at the upper side of the channel. And then you have a few options then later, as well as the channel develops, on how you get into more trend following, just as we've seen here on the way up. Another example, we're looking here at an upward sloping channel. We use that information. Okay, now we are only allowed to trade long. How does it look if we zoom in a little bit? And we are going to apply inner trend lines, other patterns on top of that. So within the bigger picture channel, you can see that we have inner trend lines here. Inner trend lines happen quite often, and you can see very often resistance turns into support. Those are amazing trading opportunities. Here you can see resistance turns into support again, turns into support at the lower end of the channel here, and then you can often see that those pullback opportunities and breakouts, retests are very, very high probability scenarios because we are going with the trend. Now let's take a look at the ADX. The ADX is a very, very powerful indicator, and we can use it perfectly to understand trend direction. And here at the bottom is the ADX. I applied it to the 1 hour time frame. This is the 14 period, just the default setting. And what you want to look for is that the ADX is above 20, very important. And also that the ADX is rising, because the ADX rising shows us that we are in a trending market. So you don't want to look at an ADX that is going down, because when the ADX is going down, it means that there is a range market and that the previous trend is losing strength. And we can see it very nicely here. I have marked a few trending scenarios. Here, for example, at 1, you can see the ADX is above 20. It's also steadily rising, and this depicts here the downward trend. Here then, when the ADX is going down, you're looking at a range market. The ADX is then picking up here again, and you can see the trend continues. Here the ADX is going up, and we have an uptrend. So the ADX is non-directional, and this means that the ADX is going up when there's a trend. It doesn't mean that when it goes up, there's an upwards trend, as we will see here. So the ADX going up just means that there is a trend. It doesn't say anything about the trend direction. And when we now zoom in, so whereas this was the 30-minute, now we are looking at the 15-minute. And we want to zoom in on those trending phases. You can see I marked them with 1, 2, and 3. And here are them on a little bit of a closer look. And you can see that within a trending market, you can see the market is going down and the price moves faster in a shorter period of time. And this is why I said in the beginning, it's so important that we trade with the trend. Because when you trade with the trend, your trades will work out faster. You don't have to hold your winning trades for that long. Which is much, much easier for your emotions and your mindset. I have coached many, many traders over the years, and I've seen that hanging on to winning trades and staying in winning trades long enough, this is one of the main challenges that traders face. And if you can find trades that work out faster, where you don't have to wait and hold on to them for a long, long period, that can help you improve your trading results. So it's very important that we trade into the trend direction. And you can see every time the ADX is picking up and the ADX is coming from the higher time frame, it shows us a very nice trending market. The market is moving lower in a short amount of time. The price is able to cover a lot of pips or points, and you can see compare that to when the ADX is going down, which means that you are in a range market. Over a long period, nothing happens. And here again, nothing happens. So we want to trade with the trend. And by the way, if you want to learn more about how I trade, I've put together a very big special, and the link to that is in the comments, the first comment below. I've put 4 trading courses into a package. So you will learn my price action course. I've also included supply and demand course, the daily bias, which is a multi-time frame approach. And if you're new to Forex, I've also included a Forex beginner course. So 4 trading courses for the price of 1. The link is in the video description or also in the comments below. And if you would like me to mentor you, you would like to have a more hands-on approach, we also have a premium Forex group. The enrollment is limited. So make sure that you grab your seat quickly, because the seats fill up quite fast, and the link to that is in the description below. You also have access to all of my courses, plus in the mentoring you also have access to our 5 to 6 live webinars every week where we cover the live markets. I show you exactly how we trade, what we want to trade. I answer your questions, I review your trades. So this is a more hands-on approach. Sometimes it really helps to change to the line graph to just get a much clearer picture, and that's exactly the goal and the purpose of a line graph. It helps you add more clarity, it helps you filter out a lot of noise, and when you do that, we are often able to look at and understand the price structure and the trend structure on a much, much deeper level. And just a little bit of a recap, in an uptrending market such as here, you see that the market is making higher highs as depicted here and also higher lows. And this is according to the Dow theory, the standard definition of an uptrend. The market makes higher highs and higher lows. And something is broken in the trend structure when the market isn't able to continue that. So when you go from higher highs here to lower highs and also to lower lows as depicted here, then often you're looking at a trend change. So it's very important that you always are aware of your trend structure and of the wave structure on your charts. Is the market continuing to make higher highs and higher lows? Or is this trend structure broken? This is very important. And we can use trend lines, for example, for that. Trend lines not only help us understand when this trend structure is broken, but they're also going to be important tools that we can use to time our trades with entries, as I will show you in a moment. So trend lines are great tools that you can use. And can you spot on this example where the market is changing its trend direction? When is it broken? Can you see it? And when we switch to a line graph, it becomes obvious. You can see here on the left-hand side, the market was making lower highs as indicated by here the bigger swings. And then here, when we draw a trend line here connecting the highs, you can very nicely see that at this point is when the market first made a higher high. And now we are looking suddenly at a new trend direction, whereas previously the market was moving down with a higher high and the breakout out of this trend line. Now you're looking at a uptrending market. Prior to the breakout out of the trend line, you can see that the market already started making higher lows. So whereas previously here you can see the market always made lower lows, here now we had the first time where we made actually a higher low. This is already a first heads up, but the trend structure change is only confirmed once the market also continues to make higher highs. So very important that you are aware of those changes in the market structure. And when you are then applying a trend line to your charts, and when you're able to describe your trends with a trend line, then there are a few ways on how you can actually get into trades. And breakouts, flags are very, very common. They are very powerful in general. And what you want to do is you want to look for microstructures on the trend line. So the trend line describes the bigger picture trend, the long-term trend. And then you are able to often analyze and understand the microstructure by using smaller trend lines. So we look at shorter periods of time. We look for important support and resistance areas. Here's probably also one. And what you then want to do is wait for the breakout, wait for the retest, and then time your trades into the direction of the trend line. That's very important. We are only allowed to trade long if you can define a long-term upwards moving trend line. And then we look for long entries. You can see here we have a flag, here we had a flag, here we have a break and retest. And we are only trading with the trend, which makes our trading much, much easier. And the trades in general move and work out much sooner. Moving averages are one of the most popular trading tools, and I have compiled and prepared two ways how we are going to use moving averages to understand and trade into the trend direction. So first of all, we can apply a moving average channel. So this is the daily time frame, and we are using the 50-period moving average, once it's applied to the high and once to the low. And what I have found in my trading, one of the most profitable trading opportunities exist on the first break and retest. So when the market is coming and trading underneath the moving average, what I am waiting for is a break and a retest into a new trend direction. So I'm waiting for the market to first break above the moving average and then a pullback into the moving average. So a break above the moving average, as indicated here, often indicates already that there's a good chance that the market may actually change from a downtrend to an uptrend. But this is not enough often, and very often you will see this pattern that the market is coming back into the moving average and retesting it. And you can see then this is the origin of a huge uptrend that is followed then afterwards. Here something very similar has happened, by the way. The market was trading lower, broke above the moving average, came into it, and then traded higher a little bit. There wasn't a huge trend, but keep in mind this is the daily, and if you use this information from the daily to then go on this candle down to a lower time frame and look for opportunities. You are still able to trade here into the trend direction for maybe 1 or 2 weeks. So still a very interesting approach. And this is something that I found in my trading, how to find great opportunities. It's a very simple approach, but try it out on your charts and you will see how effective this is. Another way what really works well is to use just the moving average as a general filter. So here I have applied the 100 period moving average, the SMA, to the daily time frame. And what we are going to do is use this as a trend directional filter. So basically, whenever the market is below the moving average, you are then going to a lower time frame, and on the lower time frame, you're only allowed to short such a market. If the price is above the moving average on the higher time frame, you're only allowed to buy the market. And then you are going to the lower time frame and you look for opportunities into the trend direction. So I marked this box. You can see the market broke below the moving average here and stayed below it. And let's just analyze on how it looks on the lower time frames. So now we are on the 1 hour time frame. This is the same period. This is still, the blue line is still the one from the daily time frame. So it's still the 100 period on the daily. And you can already see how does the trend structure look like on the micro level on the lower time frame. And we are only looking for shorts, right? But you can see there are a few periods when the market is going short. And the short trending waves on the lower time frame, they develop faster. The price moves much quicker. The price moves much further. And if you would be in those short opportunities, short trades, you don't have to hold on to your winning trades that long. In a short amount of time, you could potentially make a lot of pips. And you can see that it is true here and here, here and here as well. And when you look for the periods between those bearish trending phases, yes, the market sometimes goes against the higher time frame direction, but this is really a struggle. In a longer amount of time, the market doesn't move as much. Here we have huge bullish, huge range actually, sorry. And the idea is, or the message of this rather, is that if you are able to define the higher time frame trend as bearish, you should then only on the lower time frame trade into this direction. It doesn't automatically mean that just because the market on the higher time frame is below the 100-day that you're automatically going short. No, you're going to drop to a lower time frame and then you're applying other tools, criteria on top of that to time your trades. Because shorts will work out much sooner and much faster, and it's just going to be a much easier trading approach. Another approach for using a moving average is the so-called golden cross. And for the golden cross, what you usually do is you combine the 50 and the 200 period moving average on the higher time frame. And the idea is that whenever the two time frames, the moving averages cross, then this often describes and indicates a long-term trend change. So you can see I marked all the crosses of the two moving averages. Here, the 50 crosses above the 200, and this then foreshadows the uptrend. Here, the 50 crosses below the 200, and afterwards the market was in a bearish market. Here, again, crossing upwards, uptrend, and crossing downwards. And again, just because there is a cross of the two moving averages, it doesn't mean that you immediately get into a trade. It just means that from now on the lower time frames, you're only going to look for trades into the direction of the golden cross. And this is, I think, one of the main reasons why so many traders struggle with higher and lower time frames. Many traders believe that just because something has happened on the higher time frame, there's a crossover, the moving average has been broken, then you need to go to the lower time frame and immediately get into a trade. That's not the case. You use the higher time frame directional information, and then you go to the lower time frame and look for opportunities into this trend direction. Another great trading tool is the MACD. The MACD is also derived from moving averages, and in this example I use the MACD histogram. So I use a histogram from the higher time frame. This is the 4-hour MACD, which you can easily apply to your time frames in TradingView. So this is the higher time frame MACD, and again, we're going to use that as a directional filter. So whenever the MACD is red, we are only on the lower time frame going to look for shorts. When the MACD is green, we're only going to look for longs. Again, just because it's green, it doesn't mean you automatically open a buy order. You still need to go on the lower time frame and time your trades there with additional information. So this is how it then looks like when you have a bearish period. The MACD is below 0, it's red. This is the time period when the MACD was red, and you can already see that now the bearish phases would have worked out much faster, whereas here in a previous bullish environment on the MACD, the uptrends moved much faster. So naturally it makes sense whenever the MACD is red, you're only going to look for bearish opportunities. When the MACD is green, you're only going to look for bullish opportunities. And we can zoom in a little bit closer. So we're going to look deeper into this red box. And this is how it looks now on the 30-minute. Keep in mind, the MACD is still the one from the 4-hour chart. So we have our higher time frame MACD. And on the lower time frame, what we are looking for are breakouts, retests, pullbacks out of specific structures. So because we have determined that we only are able to trade short, now we are looking for break and retests out of patterns such as here. A very nice trend line is broken, then retested, and the downtrend continues. We have another pause. The market is giving us here this support level, and on the breakout, the market moves lower. Another support area, break and retest. Here we have a trap. So there are a few ways on how you can then actually time your trades. That's up to you which strategy you prefer. Pullbacks or breakouts, that's a little bit up to you. I made more and several videos about that. I also explain that in my courses with lots of trade studies. So if you want to learn more about that, don't forget to check the link in the video description. But the idea is higher time frame gives you the direction, lower time frame, that's where you get into trades. We can now look at this phase. So again, the higher time frame MACD shows us green, which means we are in a bullish market. And let's zoom in on that. And here we are on the lower time frame, and it's a green background, which means we are only allowed to trade long. And we are looking for pullbacks, breakouts, flags, any structure that will help us time a bullish trade, a long trade. A previous resistance is being broken and retested. We have here a trend line that gets broken. We have another resistance that gets broken and retested. We have a long-term flag pattern here that moves into a previous resistance as support together with the flag. There are many ways how you can use the microstructure on the lower time frames to actually get into trades, but the headache is gone. You know exactly what you're looking for. You're looking for buying opportunities, and then you can apply your other tools to find those trades actually. Another great tool is the stochastic filter, and it works very similar to the MACD. So we have our higher time frame 4-hour stochastic. I use a very standard setting 1433 from the 4-hour, and again, the idea is if the stochastic is below 50, we are in a bearish market. If the stochastic is above 50, we are in a bullish market. And we're going to use that as another filter. And it's very effective, as we will see. So let's try to find the lower time frame on the 30-minute. So again, this is from the 4-hour coming. And the 4-hour gives us the direction. On the 30-minute, we are looking then for trading opportunities. And we have a few options here. We have breakouts, we have flag patterns, we have triangles, we have break and retest patterns. But what you can see clearly is that the bearish trending waves work out much faster, and the market in a short period of time moves quite a lot. We have another example here. 30-minute time frame, 4-hour stochastic, and again the idea is the same. We have continuation patterns, so a retest, a triangle actually leads to a breakout and then the retest later. We have an inverse head and shoulder that allows you to trade breakouts into the stochastic direction. We have another continuation pattern here, triangle or flag, whatever you want to call it. So again, we always use the higher time frame information with the stochastic, and the great thing about actually using an indicator is that it provides you with a more objective approach. Some traders may now fear that the indicators are lagging and the signals come too late, But this is not the case. If you have been using indicators for a few months and for a few years, you will really understand the value of them. Many traders, many professionals use them. So don't worry about indicator lagging, or this is all complete nonsense that has been spread in this trading industry for many years. If you use the indicators as a directional filter, they can be a great addition to your trading arsenal and really help you understand price action and trends on a much deeper level. So I have a huge bonus for you, and I've compiled 6 price action tips that will help you improve your chart reading. I've compiled a lot of chart studies actually, so let's get into it. But before, just a quick reminder, if you want to see how I trade, I've compiled my 4 trading courses into one product, and you can get that right now in the link in the video description or also in the comments. There are lots of trade studies. There are complete and exact rules on how to find trades, how to get into trades, how to get out of trades, how to place your stop loss, how to use the higher time frames. And it's a complete trading system. And as well, if you want to get mentored by me and Moritz, we have a mentoring group where you also get access obviously to all the courses, but then we also have a live chat room. We have live webinars and a lot of great things. So don't forget to check the links below the video. And now let's get into our price action tips, and let's look at the first one. So when we look at a price chart, at first look, it may look quite random. And actually our rule and our job as a trader is it to put this random looking price action into a framework that will then help us allow to use that to find trading opportunities, to make repeatable trades. So how do we do that? And there are many concepts that we can choose from. One of the main concepts is the concept of support and resistance. So we use that information, what we have here. And what you'll see is that the market very often reacts to a specific price level multiple times. You can see that when we draw them in, suddenly the price action looks a little bit less random, right? We have a big support and resistance level here where the price continuously shows a reaction. Here you can see very precise as well. A previous resistance turns into support. So this is a great way how we can actually try to make a little bit more sense of that. And one of the criteria that you could use in your trading, and it fits perfectly into what we have done in the first part of the video, is that you only trade at key levels. So in the first part, I talked about how to find the trend direction, and how to time your trades is then used with the concept of the key levels. So maybe you're able to define with a higher time frame that you are in a bullish market. And in a bullish market, you're only going to look for long opportunities. And then you could use the concept of support and resistance to only find long entries on support and resistance levels, for example. This will help you make your trades probably much better over the long term. However, not always will be able to use horizontal levels. Also, there are periods where horizontal levels don't really fully work. And for those periods, we can then choose our so-called trend lines. And trend lines are great because they help us, as the name suggests, to describe trending markets. And here you can see we are able to connect the highs in a downtrend. So we are able to use the swing highs, 1, 2, 3, 4, 5. And we have a great trend line. And there are many ways how you can use a trend line. So some traders, as I've shown you, use trend lines to look for retest opportunities. So for example, if you are having a downward sloping trend line, you look for reactions away from the trend line to the downside. Or when the trend line is broken, very often this then confirms the trend directional change. So when the trend line is broken, very often you see that the downtrend then goes to an uptrend, or the uptrend on the breakout goes into a downtrend. So using trend lines that are diagonal or support and resistance levels can already help you make your trades a little bit less random. And you can also, of course, use that to have a multi-time frame approach. So here, for example, we are at the daily time frame. We have a huge level where the price had been trading 3 years ago. So between this point and then here are 3 years of price action. And there is a big memory, and the price has a huge memory in its trading. And you can see when we look at the current price action on the lower time frames, we can see that this line, which has been established 3 years ago, is now being used again, and the market is really actually trading at the level. Something is happening as soon as the market hit the level. Whereas for weeks and weeks, the market moved higher. As soon as the market hit this previous level, the market turned around. And we are often able to see this exact pattern at support and resistance levels. And you can very nicely use that in combination with the trend trading strategies and principles that I explained in the first part. And this is what I call deceleration, acceleration. So the market is decelerating on the way up, and then as soon as the market hits such a resistance level, it's decelerating, which means that the candles are getting smaller. And this shows you this gradual change and turn of trend sentiment. A few other examples are here. The market has a support level. It breaks below it, retests it as resistance. And as the market reaches this previous support, now as resistance, the candle gets smaller. And when you see that the candles are getting smaller, this is a very important signal that the market may be slowing down. We can often see this behavior at turning points. And the point number 3 and the tip number 3 is that wait for deceleration. And you can even nicely combine that with previous support and resistance or trend lines. So when the market is moving into a specific trend line, into a support level, look for this behavior. Look for the market slowing down at the trend line, and then look for the market accelerating away. You will often find that this is how the market is reacting at turning points, and it can really enhance your price action understanding. So pattern connectors are another point, and I love to talk about patterns. I've made many videos about pattern trading in general, and patterns are important because they are connectors. They connect either different trending phases, so they connect a downtrend with an uptrend through a pattern, or they can even connect trending markets. So we have a trend continuation environment, and the pattern is connecting the first downtrend with the second downtrend. So it's very important that we are able to spot patterns and we understand how to trade them. And yeah, as I showed you in the beginning, we often trade patterns in the higher time frame context with flags, with breakouts, with retests. They are very, very common trading scenarios and signals. So here, for example, we have an uptrend. The uptrend is coming to an end. We have a very, very nice support level that describes this pattern. And on the breakout, the market is making lower highs, as I've shown you before. On the breakout, this is where the market is making a lower low. So whereas previously we have a higher high and a higher low market uptrend, lower highs here and lower lows on the breakout. So a pattern can really nicely help you understand the trend context. And here we have another one. Whereas this was a trend reversal pattern, it connects the uptrend and a downtrend. Obviously, this means that then the uptrend is reversing. Here we have a continuation where the downtrend temporarily pauses and then is continued on the breakout. And this is often called a flag or a triangle, where the market temporarily moves sideways, doesn't continue the downtrend, and then on the breakout, this is where the trend is really continued. So very important that you wait for the pattern. Tip number 4. Patterns are often the starting point of a new trending move, and you want to make sure that you trade into the higher time frame trend direction. And if you can then find a pattern that will help you time your trades even better. So how do you actually trade patterns? And there are many ways how people screw it up when they trade patterns, and many traders then believe that it isn't working, it's too simple, it can't be that simple, it can't be that easy. But what is the main problem is that traders don't wait for the market to fully exit a pattern. And many traders are impatient, right? You don't want to wait for the market to break out. You are scared that the market may run away, that you're missing the trade, you're missing all the amazing profits that you could make. And then you enter a pattern way too early before the breakout happens. You run into a fake out, then the market moves away. And in hindsight, you look back and you see, oh, I should have never actually traded this. And this is very common. So the tip number 1 is that you always wait for the breakout. Whatever pattern you have, whether it's a continuation pattern, whether it's a reversal pattern, you always need to make sure that the market and the price is actually leaving the pattern. It is fully breaking out. So tip number 5, wait for the breakout. Always wait for the market to fully break out. Or if you don't like breakout trading, or maybe you missed the first breakout, there are often other opportunities to get into a trade. And we call it a retest, or some traders may refer to this as a pullback. And tip number 6 is that if you missed the breakout, or maybe you have traded a breakout, you made money, you exited the trade, and the market is coming back, then look for a pullback. And remember, in the first part of the video where we looked at the trend trading strategies, we have often seen pullbacks. So if you are like here in a downward market, you're only looking for shorts, a pullback can be a great way to find trading opportunities into the trend direction. And that's it. I hope you enjoyed this video. If you did, leave a like, leave a thumbs up. Make sure that you subscribe, and then I will be back in a few days with a new video.